afternoon, everyone, and welcome to the latest episode of MSME MasterClass. We are privileged to have CA Vikram Menda with us for today's MSME MasterClass on cash flow management for SMEs. With over two decades of experience, Vikram has been a trusted financial advisor guiding business owners in cash flow management, compliance, and fundraising. As a shared CFO at Finamoat Services, he and his team have helped SMEs implement robust MIS dashboards, secure funds on the best terms, and achieve 100% regulatory compliance, ensuring businesses avoid costly penalties and optimize financial efficiency. Beyond his consulting work, Vikram has recently set up a fund to finance innovative startups in India, connecting founders with top-tier investors. He also mentors entrepreneurs at ISB's Investment Readiness Accelerator, helping them attract investments and scale their businesses. Additionally, Vikram serves as an independent director at a leading manufacturing company advising on cash flow, tax compliance, and fundraising. His career spans leadership roles at Yes Bank and ICICI Bank, where he specialized in business finance, wealth management, and investment banking, even leading the prestigious Yes Bank SME Awards. He's also a sought-after speaker at NSE and ICAI forums, where he shares his deep financial expertise. Today, he's here to help MSMEs master cash flow, avoid financial pitfalls, and build long-term financial stability. Let's give a warm welcome to CA Vikram Menda.
Thank you.
Good afternoon, Vikram, and welcome to MSME MasterClass.
Thank you. Thank you so much for giving this wonderful opportunity. It's always so nice to be speaking with SME entrepreneurs, business owners. Yes, Samrit.
Vikram, my first question to you is, what are the key differences between cash flow and profitability, and why do businesses often confuse the two?
Cash flows and profitability. So, we all understand all businesses, when they are formed, when they are created, there's only one final objective, which is mostly making profits, unless you are a non-profit making organization. Now, profit making being the center of every department within the business, I have come across so many businesses that have showed awesome profits in their profit and loss account, but still they had to shut down their business. In spite of having an amazing business model, in spite of making consistent profits in their last 2, 3, 4, 5 years, still they had to shut down their profits. Why? Poor cash flow management. Now, let us understand what is profitability. Profitability is basically you buy a product at 100 and you sell it for 150. So you're making a profit. Now, it's as simple as that. Now, here's the catch. When you buy the product, you have to pay 100 now. And say in this case, when you have to sell it at 150, although you're making a profit, but that you get it after 3 months. So now the challenge here is cash flow management. How will you pay these 3 months office rentals, the salaries, the expenses, the interest cost, EMIs for these 3 months? And one of the biggest mistakes what business owners make is they focus only on increasing profits. Every department is focusing on how can we increase sales. And sometimes it happens so that in spite of they making an awesome profit, they don't have cash to probably sustain for the next 2-3 months. So at Finamoat, which is my firm, we keep saying that profit is vanity. Vanity is something like on paper, out of thin air. Sales is sanity, and cash flow is reality. So if you have to really make a mark in business, if you have to really survive for long and make an awesome impact, so you need to really focus on cash flows. So that's the difference basically. Just to give you an example, the classic example of Vodafone versus say a Reliance Jio. Now, Vodafone idea was in business, in the telecom space since so long. They had been making awesome business, good profitability, but they didn't have cash flows. Now, when Reliance Jio came in, thanks to their support from Reliance Industries, they had such huge cash reserves that they were able to give awesome, attractive offers to their clients. They attracted so much of people right in their first few months. So that's what cash reserve does. So basically, it not only gives you that capability to have a state-of-the-art infrastructure, it also gives you an opportunity to attract a lot of customers and also wipe off competitors. So
But how can businesses ensure steady cash inflows without relying on debt?
Without relying on debt, now here we assume, or there's a assumption, silent assumption there that debt is bad. So a lot of entrepreneurs have this misconception that debt is bad, which is not true. Debt is a very, very powerful tool for business growth, for business expansion. When I say it is good, it should be a tool. So what do I mean by tool? The SME promoter, the business owner, they should be using debt. But the problem happens is sometimes debt starts using the business owners. So I would say debt is very good, but only when used judiciously. In fact, I would go on to say that some of the biggest clients that we have in SME businesses, their biggest business is not that product. Their biggest, I would say, not business, but the source of their wealth creation happens because they are able to kind of take monies at 8%, 9%, and this money they are using in business, which is generating them 20, 30, 40% ROI. So in this case, what is happening is they're generating massive wealth in the long term. So first thing to understand is debt is not bad. But having said, to answer your question, if still you want to kind of, I would say, not over rely on debt, because debt is good only till a point. The problem happens when there is over leverage, over debt, too much of debts and very less of your own money.
Understood.
So here, if I may answer your question, how do we ensure that there are steady cash flows? The first thing that we need to do is we need to have clarity. Clarity on what? So typically we get a lot of clients who come to us and say, okay, Vikram, I need 50 lakhs of money, 50 lakhs of working capital for business expansion. So then we give them a pen and paper and we tell them, okay, tell me where all this money would be used. Believe me, out of 10, 9 people, they are not able to give a clear list of that 50 lakhs, whatever working capital is needed. So here the first thing that we need is clarity. So at the entrepreneurial level, I would urge the promoters, the business owners to have clarity on how much money do you need, for what purpose do you need, for how long do you need, and most importantly, how will you repay that debt? So most of the people, in fact, in businesses, they don't even need working capital. So we have a lot of businesses which have a negative working capital. That means their clients, their customers, they are paying 1 month in advance, but they have to pay their vendors a month or 2 months later. Now, even in such cases, there are a lot of businesses who go into take a loan. Now, again, here you need to take a check. You need to check, does my business really need working capital? Or is it because my business is not making profits? So here, as I said, the first step that we need to do is we need to gain clarity on is there really a working capital gap, or is there a profitability gap? So if I have to sum it up into probably steps, so the first step that you need to do is clarity on whether your business is profitable. That's the first step that you need to do. And here I would urge the business owners to kind of have a third party view. Again, many times what happens is business owners, they love their baby so much that they think everything in their business is awesome. So it's like everyone feels their baby is the best. So here we urge people to have that. The second, clarity on the break-even point. So if you want to avoid debt, you need to know what is my break-even point in my business. So right from our school and college days, we were given a very clear passing marks. So we knew, okay, we want to take that 35 marks and then we pass. But in business, we are not loose. So we don't have any clarity on, okay, what is my passing mark? Passing mark here means the break-even point. What break-even point here means is basically what is the minimum amount of sales that you need to do to actually take care of your expenses. Now, most people, most business owners, they do not achieve this because they haven't even calculated that. Again, if you have to really calculate break-even point, you also need to calculate, okay, what are my costs? And basis that, basis profitability, you calculate, okay, this is my break-even. And then, of course, once you have the clarity, then comes, okay, very clear steps on how will you achieve these goals.
Got it. Now, moving on, what are the most effective strategies for accelerating receivables without straining customer relationships?
So when it comes to receivables, I would say business owners, especially in the SME space, the small and medium enterprise space, now receivables management is the most critical in cash flow management. So when we say, okay, profitability is important, but cash flow management is even more important. Within this cash flow management, receivables management is the most important. Why? Because most of your business is sales. Everybody is focusing on increasing sales, but very few people are actually ensuring that this money that you take, money that you ought to take, is being received on time. So if you're asking me most effective strategies, I would start with most SME owners where they fail in receivables management is they have a very unstructured receivables management. They make two kinds of mistakes. One, they don't have a follow-up system. Second, even if they have it, it's very unprofessional, very unstructured. So if I have to again give you the strategies, I would list down few strategies. The number one or the biggest problem with most SMEs in receivables management is the invoicing doesn't happen on time. Most SME owners, again, as I said, there's a very unstructured way. So they do not share the invoice on time. Ideally, the day you deliver your product or the day you deliver your service, the invoice should be mailed, number one. Not only mailing it, but also a call should go to the client saying that, thank you, sir, thank you so much for giving us this opportunity to do business with you. And we've also sent you an invoice. So again, here you need to check whether the client has actually received it. There have been several cases where 2 months, 3 months down the line, and the client says, you didn't send us an invoice. We haven't got an invoice. So you save those 2-3 months, right? So it has to be very structured. Number one, it has to go on time. Number two, immediately after sending it, you have a call. One more big mistake here is, SMEs, either they don't have someone calling, or even if they have a collections RM. So most of the SMEs, they have a separate team, which is called as a collections RM. What this RM, poor guy or girl, he does is, he calls up each of these people. Okay, I'm calling from ABC company, and this is your amount of receivable, and sir, when will you pay? Now this poor guy or girl, he has no rapport with the client. The client has absolutely no reason why he will speak to him. He doesn't have any context. The RM, he doesn't have a context of the client, the product, the service. So here again, we advise our clients to strictly abstain from this collections RM concept. So instead, what we suggest is an accounts RM. By accounts RM, I would say the person who is in charge of delivering that product or service. Now what happens is, this person is the reason, he is a single point of contact for that client. So does he have rapport? Yes. No. Can the client avoid this particular person's call? No. Does this person has a complete context of, okay, what went on during the sale? Yes. Was he a part of the negotiated payment terms? Yes. So he is the person who should be in charge of also the recoveries, the receivables. Again, here where we could help this person or where we could empower this person is, we provide him the exact MIS. So again, here clarity plays a big role. So whenever this RM, he calls that person, okay, sir, how was the product, how was the service? You take a feedback, you have a feedback on how was his experience. The client feels good, right? He feels heard. Even if he has issues, someone listens to him. And that is a time when you ask the client for two things. One is, of course, you ask for, okay, sir, when would it be possible for you to release those funds? And of course, he could go for upselling, cross-selling. He could go for some referrals. So, एक ही call में दोनों फायदे हो जाते हैं. So that's the way. And so at Finamoat, what we do is we also handhold a lot of SME promoters get into receivables management in such a way that this entire process is very, very structured. So what I mean by structured, we have a automated messaging system. So an automated emailer goes on the day of the invoice, step number one. Exactly 30 days later, and a gentle reminder two goes, which is an add-on to the earlier mail, a follow-up on the earlier mail, which says that so and so. Now this is also very gentle, very polite, very professional. So what happens is 60 to 70% of the people, they pay by this time. Now there are few people who require more follow-ups. So then there are few additional systems, additional tools such as automated reminders, which help the RM expedite this entire receivables management faster. And last point is we have a weekly a collection review, a weekly collection report. We advise, we suggest the business owners to sit with their accounts RM, the RM who's in charge of the receivables, and minutely track, okay, what all monies have to be received, what was the status, what is the progress, and anything where they need to intervene. Right, so these are all the strategies which can probably expedite the receivables management. Even after doing this, even after doing all this, there will be few people who will not pay you on time. So the thing that you need to do is you need to accept that. You need to weed out such people who are either not paying you on time, who are not paymasters, and probably you can keep your own system of weeding out 20% of such of your clients who are not paying you on time, and rather you interact with, or rather you deal with the 20% of the paymasters.
Now, how can delayed client payments impact business operations, and what measures can be taken to prevent them?
So the impact that it can make is huge. As I said, like cash flow management is very important. You may be making huge profits, but if you are low on cash flows, it's of no use. Within that cash flows, receivables management occupies the major portion. And if that is flawed, if that is weak, unstructured, your cash flows go for a toss. So the impact is huge. Some very basic examples. We have, like, in the last 2 decades, we have worked with so many SMEs and so many SME promoters. Like they have an excellent, again, awesome business model, very established clients, marquee clients, as they say, very reliable vendors. They have huge distribution model pan India. But on the first of every month, they think, okay, now how do we pay salaries? How do we pay our rentals? And even how do we pay our GST? Now, GST is something that your client is anyways paying. So I am, say, selling a product of 100 rupees. I am being charged, or rather I am charging 100 plus 80. So my client is anyways paying 100 plus 80. Now, even if I assume that the client has paid that 18 rupees GST additional to you, still there are so many cases who are not able to deposit this 18 rupees to the GST department on the 20th of the next month. So to answer your question, like the impact is huge. I mean, we've come across so many such business owners, like, who have to take then loans, expensive loans, not because the business is bad, but because the receivables management is bad. They had this pressure, sales padhao, sales padhao. So they go on to increase sales at the cost of reduced cash flows. Then to bridge that gap, they go in for loans. Against these loans are taken against their business assets, still okay. But there are so many loans which are taken against their home. We have loans, I mean, so many promoters who take loans against their personal assets. Like I literally beat myself every time I come across a business owner who has taken a loan to pay off his office salaries, especially when this loan is taken against his wife's jewelry. So, I mean, I really feel bad about that. Like most business owners, they attach themselves with the business so much that business becomes their only identity. And they can go to any extent just to stay in business, just to pay off their business debts. And like, what good is your business if it is unable to pay your business expenses, it is unable to pay for your personal expenses? So again, this is the impact. And the second part of the question, what measures can be taken? So the measures we've already mentioned in the earlier response. The first is invoicing on time. Second, you have a professional follow-up system. Third, you have an accounts RM concept.
Can you also tell our attendees what are the best practices for structuring vendor payments terms to maintain a healthy cash flow?
Okay, so when you say vendor payments, so till now we were discussing receivables. Now we come to the payables part, the payments part, right? Now, as important as the receivables management is, now you've passed the first test, you've got the monies. Now it comes to repaying those monies to your vendors. I would say the first and the most important is you need to have negotiated terms of contract with your vendor. So, and these terms should be such negotiated that it should be in line with your receivables terms, because it should not happen that your monies are coming probably say 2 months later, but your system with your vendors is you have to pay in advance. How will you even make profit? Or rather, how will you even survive? How will you even sustain? So this term should be negotiated in line with your regular cash cycle, number one. Number two, it should be clearly communicated on email. Again, here, most business owners, they fail on the communication part. There is some verbal discussion happening, but it is never documented. And everything is fine till things are good. But the day something goes bad, all of these small miscommunication, lack of communication, it plays a big. So the number one point is negotiate and communicate, number one. Second, I would say we have, a lot of SMEs, a lot of business owners, they have a system where invoices received by the 30th or the end of this month will be paid by the 15th of the next. You can have a system like that. So again, this could be communicated to your client. What this does is, so you accumulate all the vendors. So on the 30th or the 31st of that month, you have a clarity on, okay, who are the vendors I have to pay, number one. Number two, you get 15 days of grace period to kind of accumulate the funds needed to pay them. Number three, you can prioritize, okay, whom to pay first, whom to pay second. It doesn't happen haphazardly or randomly, right? Next, you need to ask for discounts if you're paying on time. Again, here, for this, you need to know, okay, what are the market terms? How is the payment system with other competitor vendors? So again, we suggest our clients not to have all purchases done from a single vendor. So you have multiple vendors, you keep tracking the vendors, you also have an understanding of how does the market work. Just to wrap it up, I would say the first thing that you need is you need to have your terms of contract very clearly negotiated and communicated. Second, you need to have a very clear system, invoices received by a particular day of the month. You can probably pay by the 15th of the next month. Third is probably you can have a discounted system if you're paying on time. You keep looking for better negotiated terms, better credit terms with different vendors. You regularly review your payment system, payment terms. And lastly, one of the easiest way is you use a credit card system. So again, we have so many credit cards which also give a lot of discounts, rebates, cashback system for especially air travel, hotel bookings. So, and SME business owners can take benefit of that as well.
Yeah. Got it. Vikram, my next question to you is, how can businesses optimize their working capital to avoid cash crunches?
So, cash crunches basically when your payables are more than your receivables. So again, if you have to avoid that particular thing, the only thing that you need to do is you need to keep measuring that, keep monitoring that. So we say whatever gets measured gets improved. Again, typically SME promoters, they do not have a MIS or a dashboard system. Even if they have, very few have, the only thing that they really measure are only two things. One, they measure sales. Okay, what was the increased sales? What was the sales that we did last month? And second, they have a very rudimentary, very basic and elementary kind of MIS, which just tells them, okay, what is my bank balance? What are my payables? That's it. Now, how does this enable you to actually take a business decision? Right. So we are living in a world where everything is driven by data. We have big data, we have AI. So this poor SME business owner, he is relying only on his business gut, only on his gut feeling to take any business decision. So again, here we advise our clients to have a very clear an MIS or a dashboard. Again, this MIS dashboard needs to focus on the right metrics, right measures, which will exactly identify, okay, where are you now? So as you said, cash crisis. We need to start by understanding, okay, what is cash crisis and how does it, what is the result, what is the reason for that? So see, basically, a working capital is nothing but your stock plus debtors plus receivables minus your payables. An income tax refund, which is due from some end, or probably a deposit, which is due from some end, or probably you have made an advance or a loan given to someone and this loan is due back to you. Now, all of these are again receivables. So you need to keep a track of this. You need to have your receivables team also focus on getting this recovered. Having said all this, we also need to focus on the payables part. So once you keep a track of all this, automatically you will avoid any cash crunch in the future.
Understood. Now, Vikram, what financial metrics should be tracked regularly to monitor and improve cash flow?
Yes. So, see, metrics are very important. So, in fact, in my earlier response also, I told you the biggest problem is the MIs that people have. Either they don't have it, or even if they have it, it's very elementary. So, we need to understand whenever we speak of metrics, there are two kinds of metrics. One is we call it as the lag measures, and other is we call as the lead measures. Most business owners, what they do is they focus on the lag measures, the result measures. Now, lag measures or result measures are something like what is my sales, what is my profitability, what is my cash balance. Now, all of these which your typical business owners focus on, these are all called as lag measures, result measures. What instead we need to focus on is the lead measure. Lead measure would be, if I focus on sales, then I need to focus on, okay, how many leads do I have? How many calls are going from my office? What is the conversion ratio of these calls? Right. Again, here we are only at the tracking system. Are we tracking it? Then how many quotations or proposals or mandates are going from my office every month or every week? So we have a weekly MIS system where the clients have a internal review meet where they track this on weekly basis. But just to give you a gist of what all things that you need to measure, you need to have, number one is your business performance, where you need to focus on what are your sales, what are your costs. Costs, again, you need to bifurcate them into what are your variable or the production cost, what are your fixed or office cost. In return, what is the profitability? Again, once you know the profitability position, you also need to know what is the cash position. So here we focus on what is the cash in hand, what is the bank position. Again, here what are the cash inflows, the cash outflows, मेरा receivables कितना आया, मेरा payables कितना I paid them. In effect, what is my cash balance? So here what we come to know is, okay, what is it that is, अगर मेरा cash crisis है भी, तो what is it that is causing me the cash crisis? Probably sometimes it happens कि my debtors, the receivables which are from trade, from business, they are working fine. But I have a huge receivable from the income tax refund department. Now, mostly this goes untracked for several months, and one fine day the promoter remembers, "Arey, how we had to receive that, say 50 lakh rupees. Where is that money?" So it is better if we keep a track and we ensure that we get it. Similarly, there are several such receivables. Again, we also have a separate system for when we say receivables, which are the debtors which are more than 30 days, which are more than 60 days. So these are called as the sticky debts. Again, payables which are the payables which are like very urgent. So fire crisis किसका है, stock कितना है. Again, within stock, is there something which we need to worry about, something like an obsolete stock? Then we need to focus on the fund position. See, business can be seen in two sides. One, मेरे पास कितना पैसा कहाँ से आया है और वो पैसा मैंने कहाँ लगाया है. So as a business owner, if I am very clear, okay, this is the sources of funds. Say example, the total funds employed in my business is say 10 crores. So I need to understand this 10 crores, where is it coming from and where is it gone? Why do you need to know this? Because I need to know कि okay, ठीक है 10 crore यहाँ से आया, so I come to know okay what is my costing, and जो गया है 10 crores जो apply हुआ है, जो employ हुआ है, उस पे ROI कितना है. Only if this ROI is more than this cost, I am actually making profit. I have seen multiple businesses which are having 10%, 20% profit margin, but at this fund level they are making losses. So profitability has to be measured on both levels, at a margin level and also at compared to an investment level. The last metrics that you need to focus on, which you cannot ignore, especially now in the current scenario, is compliances. So you need to have a very clear idea, okay, what are the compliances which I need to take care of? What are the compliances which probably I have missed? What are the compliances that I have probably missed? And something that I need to take care of at a very, firefighting kind of a thing. So ये सारे metrics है, which if you kind of, I still say, a lot of people say, okay, what will happen just by measuring it? If you do this every week, every month, slowly after 3 to 4 months, there is a very visible improvement in the organization. People start noticing, okay, things are changing. The entire organization, they start giving focus on the things that really matter. Suddenly, the promoter asks relevant questions and he focuses on the relevant parameters which ensure profitability, which ensures liquidity, which ensures you earn a good return on your investment. So again, this will not happen overnight. It will take at least 3 to 6 months, but you need to start today.
Moving on, Vikram, what are the risks associated with having too much cash tied up in inventory and how can they be mitigated?
So, we discussed, if you have to do working capital management, you have to focus on debtors as well as you have to focus on stock. Now, what are the risks associated with too much of cash in inventory? The biggest risk is your money gets locked. So you require higher working capital, your interest outgo is high. Not only is your money locked, but also you have to incur extra expense just to kind of manage this. So you have to have a bigger go down, a bigger warehouse. You have to ensure that that stock is maintained. The holding cost gets increased. Then there are a lot of stock thefts, there are stock damages, pilferages. So we have the excellent example of Subiksha. Now Subiksha was an awesome business model. It ran its business for more than 10, 15, 20 years. But when it expanded, it couldn't manage the stock. So there were a lot of stock pilferages that happened. So we had several news that an entire truckload of stock was missing. And even if the stock was there, a lot of places it had this getting obsolete. So these are all the impacts, or I would say the risks which are associated with a lot of money being invested in inventory. Second part of the question, how can this be mitigated? you need to measure everything. You need to track everything. So again, here what happens is at SME level, at business owner level, they need to first identify what is my star product, which is my star product. What do I mean by star product? There are two criteria. One, it's a fast moving product, churning fast. Second, it has high ROI. So say for instance, if I'm investing 10 rupees on that product, I'm getting say 30, 40, 50 rupees. So the churning is faster and I get a higher margin also. Similarly, you also identify on the other side, which is my loser product. Now, loser product would be your slow moving product and also which have a lower margin. So what you need to do is, first you need to identify. Second, you need to outsource your loser product to an external agency, if possible. The idea is you need to focus on your star product. You need to focus on product with higher margin, and also you need to focus on the client that gives you a higher margin. So what I was saying is the other thing that you can follow is, after you identified your star product, your loser product, you kind of outsource that loser product. Then you have your just-in-time stock system where you ask your vendors, okay, whenever I call you, you just deliver me the raw material the same day. Now what that does to you is it reduces your investment in inventory, number one. Number two, there are no cases of increased holding costs, no warehousing, no storage. Number three, you get the freshest stock the same day. Number four, there is no case of stock obsolescence. So this is one thing, one way probably you can reduce your stock pilferages and stock investment. Next, you need to maintain a very detailed and probably automated stock register. You need to conduct periodic stock audits to check whether any of my stock is probably 6 months, 12 months old in the system, and you need to continuously track that. Also, you need to track if there are any samples given. So a lot of business owners, what they do is they either give samples, or within branch or factory there are transfers of material, and a lot of times a lot of pilferages happens in that scene. So here I would say these whatever transfers or samples, they need to be tracked very, very minutely, because although at the face of it, it looks okay, ठीक है, 1 kilo 2 kilo किया, but in the entire 1 year, this amount comes to huge.
Correct. Now my next question to you, Vikram, is how can businesses reduce their dependency on external financing for daily operations?
So see, basically external financing would be, I would say banking, or probably nowadays with all this Shark Tank and all, a lot of people are also going for venture capital and startups. So as already we mentioned, debt is not necessarily bad, but if someone has to reduce their dependency on external financing, you need to focus first on the receivables management thing. Second, you need to again negotiate your payment terms with your vendors. Third, most importantly, is you can start a cash reserve within your organization. So everybody understands of a TDS concept, which is tax deducted at source. So I'm supposed to receive 100 rupees. Out of the 100 rupees, 10 rupees is deducted at source and I get 90 rupees. Now, similarly, I mean, the government is now deducting, say, 10 rupees. Why can I not deduct 10 rupees for my future? So that is where we come out with a concept called as IDS. IDS is investment deducted at source. So whatever money that you receive, 10% of that should directly go to your cash reserve. Now, believe me, I get a lot of resistance from business owners when I say this, because here we are, typically people are actually struggling to pay their rentals, their salaries, their GSTs on time. And here I am being preachy and saying, okay, you have to have 10%. But how you start is, you can start with as little as 1%. So 1% of your receivables, if you are receiving 1 lakh rupees, you just deposit 1,000 rupees. Is that too much to ask for? No. So what happens is, with this 1,000 initial start, the system gets implemented. And gradually what happens is, You increase that 1% to 5%, 5% to 10%. And over a period of 6 months to 12 months, this starts working seamless. Next is you identify a list of your assets and receivables pan India. Again, a lot of business owners, what they do is their business is so widespread, they lose track of, okay, where all our assets are there. So again, in one of the case, one of our clients had a distribution pan India. It had its trucks pan India. So at one point of time, they were like short of cash, and they had come to us, okay, Vikram, we need whatever X amount of bank loans. Can you help us? And then we just did this. We just identified, okay, list of their assets. And you won't believe it, almost 80 to 90% of whatever cash crunch they had, they fulfilled that cash crunch just by disposing of those assets. So they already had that asset. It's just that you need to track it and also sell it. Next is, of course, you identify what are the list of deposits that you have. As an organization, we have a lot of company related, electricity board, telephone, income tax, GST, so many deposits at so many places. You need to identify that, and you need to identify, okay, kahan se I can take those GST department, this huge this ITC, which we call. A lot of exporter clients, they can take back that money, but they don't have a system to take that money. They feel ki, okay, a lot of money would be used to take that money or to get that money, but it's not that way. So these are simple monies. You just need to ask for it and you will get it. Lastly, you can have these business or geographies which are not profitable probably. So again, here जो star product or loser product था, here we identified star geography or loser geography. So again, in one of the cases, there was this basically a medical pharma related company. They were making awesome profits in Maharashtra and Goa, but they were losing terribly in Gujarat and northern areas. So, and they were facing cash crunch, liquidity issues, every kind of issue. What we did was we simply identified, okay, let's close down these sectors and let's focus on these sectors. You won't believe it, within 8 to 9 months, they were hugely cash surplus just by doing this one thing. Yes.
Right. Now, Vikram, what role do digital payment solutions and automated invoicing systems play in improving cash flow efficiency?
Sure. So today, thanks to the technology space, we are like bombarded with so many digital payment solutions. We have like automated invoicing systems. We have like systems like Zoho. We have QuickBooks. We have Razorpay. We have these automated systems where probably they get an automated calls. Okay, you have this and this amount receivable or sorry, payable to so and so company, and please pay it within so and so. So all these systems, what it does is it eases away a lot of your personal bandwidth, your team's bandwidth. So you have like faster payment processing. You have a reduced manual error because the system is entirely automated. There's very less to do manually. And I would say with SME level mein, you can see at the large corporate level, they have huge capital, they have huge manpower. But at the promoter level, we have to be very nimble, we have to be very efficient to really stay in that space. And all these digital systems, what they do is they give you that efficiency system at a negligible cost. I mean, at a peanut cost. So here you have an improved billing efficiency. So you don't need to keep a track. Okay, when do I send the invoice? Everything happens automated way. So the day the product is delivered, exactly that day invoicing happens. There's an email that goes, there's a call that goes. 1 month later, again a gentle reminder too goes, a call goes. There's an escalation system also. So everything works very, very seamlessly. As a result, what happens is your business becomes more viable, the transaction costs are reduced, and the entire systems works integrated. So you don't need to have a separate system for accounting, a separate system for billing, a third system for probably recovery. Now, all of this can work like one integrated system. So what that does is it gives the promoter, the business owner, a lot of control over his business.
Vikram, how can businesses build a cash reserve strategy to manage unexpected financial challenges?
So I would say, so cash flow strategy, I would say the basic thing which we suggest all our clients is you maintain 4 bank accounts. Typically, what happens is every organization they have 1 or 2 bank accounts. We suggest 4 bank accounts. Why 4 bank accounts? See, what happens is the number one problem with all these financial challenges that you mentioned is, as we discussed, how do I pay my GST? How do I pay my expenses? So if I have everything segregated, then automatically this problem goes away. So we learned this from our forefathers. Like they were so wise, they had a separate money jar. You would have seen, no, माँ के operation के लिए, and so something on those lines. We have these 4 bank accounts. The number one is your receipts account, where all the monies from your debtors, from your receivables, they come in. Now, whatever money comes in this bank account, 10% of that goes into a separate account, which is called as a reserves account. Right. So the system we called a cash reserve, 10% of that. Depending on your business, 20 or 30% of it, whatever income you receive, goes into your expenses account. Now, these expenses would be your office salaries, your rentals, your EMIs, whatever commitments you have to make. And the balance 70% goes to your supplier payments account. Now, this is a different account. Now, once you have that system, only 2 things can happen. Number one, it can work smoothly. If it does, congratulations. If it doesn't work smoothly, you exactly know where's the problem. So what you need to work on so that you come out of this financial challenge. So, and I always tell, clarity is the first step. So once you need to, first is you need to diagnose, you need to have a system to diagnose. Second, you need to know, okay, यहाँ पे मुझे, if I have to change something, what do I have to change? In the expenses section, which I mentioned, I urge the promoters to include 3 things, which generally they don't include. The number one expense is your own salary, the business owner, the promoter, the founder. So their salaries. Number 2, salaries. Thanks to these a lot of business coaches, we already know of salaries. But there are 2 more things which a lot of business owners still don't provide for. Number 1 is rent on your office. Again, a lot of my business owners, they have ancestral offices. So their father or grandfather had their offices in, say, South Bombay, and lush offices, big offices, and they don't count rent on that. Again, there's huge capital that has been invested. Again, your father, your grandfather level, nobody is actually calculating what is the interest on their promoter capital. In fact, just to give you a statistic, there have been so many cases where the promoters, the business owners, would be far better off if they sell off that property and probably invest it somewhere else. So if you do all this, if you have a track, if you measure these expenses and have this compartments, I'm sure you would be out of the financial challenge.
Correct. Vikram, my second last question to you is, what common mistakes lead to cash flow crisis and how can they be avoided?
So I would say, see, there are only 3, there's so many mistakes, but these mistakes can be segregated or can be clubbed under 3 different heads. One is lack of clarity. Second is lack of controls. And third is lack of reporting. So when I say lack of clarity, clarity on what is your product cost, what should be your product pricing, what is my profitability, what is my break-even point. So you need to have clarity on this. So this is one of the biggest mistakes. The second most common mistake is lack of controls. So when I say controls, you have your preventive controls as well as your detective controls. So here what I mean is you need to have a proper KPI, KRA. What are the key performance indicators, key result areas? How should your MIs? So the concept that we discussed about the different financial concepts that need to be measured and of course controlled. This is the second, which is lack of control. And the third most common mistake is lack of reporting. Now, by reporting, what I mean is you need to have a weekly, monthly, quarterly system. So again, as we discussed in the receivables side, so we have a weekly receivables reporting, a monthly MIS reporting, quarterly KPI reporting. So all of these things should go very, very ritualistic. So if you have all of these, there will be absolutely no cash flow crisis. And just to probably add on this, here, whenever you have all of these controls or measures or reporting, you always focus on the lead measures. A lot of SME promoters always focus on the lag measures, and they get frustrated and they stop that system. So you should not do that, and you need to also focus on not doing your own surgery. So here you need to hire a third-party person to kind of diagnose what is not going right in the system.
Right. My last question to you, Vikram, is what are some of the real-world examples of companies that effectively managed cash flow and grew sustainably?
So basically there are so many. I mean, I would say in a business there are like 7 departments. So it is like you have marketing, you have sales, you have HR, you have operations, R&D, management, and lastly finance. So if you see, Amita, all of these 6 departments, apart from finance, all of these 6 departments, be it marketing, be it sales, all of these departments take your business up. Marketing can take your business up, sales can take your business up, operations, service delivery up, R&D up. There's only one function which can take your business down, and that is finance. So basically, if I have to say some real life examples, I would say you take any example of a company which has to shut down its operations, be it Satyam, be it Infosys, be it Satyam, be it Geetanjali Jewelers, or probably Arthur Anderson. Now, all of these systems, they had excellent business models. Everything was running fine. But the only mistake that they made was in finance. So these are the cons side to it. On the other side, we have so many companies which are doing exceedingly well. Companies like the Apples of the world or the Reliances of India. Like one big thing, of course, they have an awesome business model. They have an excellent product, but they are managing their cash flow finances awesome. So to give you just a few examples of few SMEs, since large corporate you wouldn't be able to relate to. If I have to give example probably of an SME, so I'll just give you a very simple example. Now there was this SME which was into this thing. They were into providing consulting services to corporates, large corporates. And they came to us with, okay, Vikram, we need say X amount of working capital. When we did a diagnostic, we came to know that they were again a negative working cycle. Right. Now, if you are a negative working capital cycle company and still you are asking for money, what that means is your business is not right. So just by managing certain changes in the cash flows, by regularly having a tracking system, by having a proper financial metrics, what we did was within 8 months, they were a cash rich company. And that is how just pure cash flow management. The business remained the same, customers remained same, everything, vendors were same. Only thing that changed was the financial management. And their profitability and everything, profitability, cash flows, everything like changed 180 degrees.
With that, we've come to the end of today's episode, Vikram. Thank you so much for giving your valuable insights to our attendees and sharing this intel with us.
Thank you. Thank you so much for giving me this opportunity. It is indeed so nice to be speaking here. Thank you so much.
For our attendees who are online, if you'd like to see the current episode, if you've missed any part of the current episode, you can go on YouTube, type GSW1 MSME, and you will find all the episodes uploaded there. Thank you once again, Vikram. Bye-bye.
Thank you.